Opendoor Technologies, ticker symbol OPN, is currently trading at $8.14, which is a drop of 35 cents or 4.12% on the day. Now, seeing a stock down over 4% in a single session might send many investors running for the exits, especially a name as volatile as Opendoor. The immediate expectation is that something is fundamentally wrong, that the bearish narrative surrounding the housing market is finally catching up and pulling the stock down for good. But the reality of what's happening with this company is far more nuanced than a single day's price action. That drop you see on your screen today isn't the whole story. It's just a single chapter in a much larger, more complex saga about technology, data, and a high-stakes attempt to reshape one of the world's largest industries. While many are fixated on rising mortgage rates, the real story is happening behind the scenes, in the company's algorithms and its strategic balance sheet management. The common belief about Opendoor is straightforward. It's a housing flipper at massive scale. People think its success is tied directly and exclusively to the health of the U.S. housing market. If home prices go up, Opendoor wins. If they go down, Opendoor gets crushed, holding billions of dollars in depreciating assets. It's a simple, easy-to-understand narrative, and it's why so many investors on platforms like the Robinhood app or those using SoFi Invest trade it as a pure proxy for real estate sentiment. But this view is fundamentally incomplete. To see Opendoor as just a house flipper is to miss the entire technology-driven value proposition. It's like saying Nvidia stock is just about video games. The deeper truth is that Opendoor is a data company that happens to use single-family homes as its primary asset class. Their success or failure won't just depend on the direction of home prices, but on their ability to price risk more accurately than anyone else in the market, a feat that requires immense computational power and sophisticated data modeling. Let's break down the recent market activity to see what's really going on. Today's 4.12% decline is happening on significant volume, suggesting that there is some real conviction behind the selling. We're seeing more institutional selling pressure than we have in previous weeks, which could be a reaction to the latest inflation data and the subsequent chatter about the Federal Reserve's next move. Every time the Fed hints at being more hawkish, stocks sensitive to interest rates, like Opendoor, take a hit. This isn't unique to Opendoor. It's a sector-wide phenomenon. But here's where it gets interesting. While the short-term traders are selling, some long-term institutional holders have been quietly adjusting their positions. A look at the latest filings shows that while some funds are trimming, others, managed by platforms known for long-term horizons, similar to what you'd find in Fidelity mutual funds or as part of a diversified Schwab intelligent portfolio strategy, are maintaining or slightly increasing their stakes. They aren't reacting to the daily noise. They are making a calculated bet on the long-term viability of the iBuying model. This divergence between short-term sentiment and long-term institutional posture is a critical piece of the puzzle. An investor just starting out with self-investing needs to understand this dynamic. It's not as simple as watching the daily chart. Proper online investing requires looking at who is buying, who is selling, and why. The last earnings report was a perfect example of this expectation versus reality conflict. On the surface, the numbers might have seemed mixed, with guidance that reflected the challenging macroeconomic environment. The stock initially sold off. But for those who listened closely to the conference call and read through the financials, there was a different story. Management detailed significant progress in their pricing algorithms and operational efficiency. They showed a clear path to improving their contribution margins even in a flat or slightly down market. They are becoming better at buying and selling homes, reducing holding times, and managing renovation costs. This is the core of the bull thesis. It's not about hoping for a housing boom. It's about executing flawlessly in any market condition. This is the kind of detail that dedicated traders on platforms like Interactive Brokers, known for its sophisticated tools, would be analyzing. They're not just looking at revenue, they're looking at the unit economics. The average retail investor might miss this, but it's the most important factor for the company's long-term success. So what exactly does Opendoor do? At its core, the company operates as an iBuyer or instant buyer. A homeowner can go to Opendoor's website, enter their address, and within a short period, receive an all-cash offer for their home. If they accept, Opendoor buys the property, makes some minor repairs or upgrades, and then lists it back on the market for sale. Their revenue comes from a service fee, typically around 5%, and any appreciation they can capture on the home's resale price. This model is designed to eliminate the uncertainty, lengthy timelines, and stress of a traditional home sale. The entire business hinges on their ability to accurately value a home and predict its future selling price. This is where their technology and data science come into play. They analyze thousands of data points on a property, the neighborhood, and the local market trends to generate their offers. It's a world away from the traditional real estate agent model and represents a fundamental shift in how residential real estate transactions could be handled. This is the kind of disruptive model that often attracts a lot of speculative interest, similar to the early days of Tesla stock or other tech innovators. Investors using Fidelity trading platform or SoFi trading platform can access this stock, but understanding the underlying mechanics of the business is crucial. Looking ahead, the future for Opendoor is a landscape of significant opportunities and equally significant risks. The bull case scenario is compelling. If mortgage rates begin to stabilize or even decline, we could see a resurgence in housing market activity. This would provide a massive tailwind for Opendoor, increasing transaction volumes. Furthermore, as their brand recognition grows and their pricing models become even more refined, they can continue to take market share from the traditional real estate industry. They are expanding into new services like mortgage and title, creating a more integrated ecosystem that could significantly boost profitability per transaction. This is the vision that long-term bulls are invested in, a future where Opendoor is a one-stop shop for residential real estate, a true digital platform for the industry. How many of you watching are homeowners who've considered using an iBuyer like Opendoor? Comment below with your experience or your hesitation. However, the risks are as real and cannot be ignored. The primary risk, and the one that keeps bears up at night, is a severe housing market downturn. If home prices were to fall sharply and suddenly, Opendoor could be left holding billions of dollars in inventory worth less than what they paid for it. This is the existential threat to their business model. While their data models are designed to mitigate this risk, no model is perfect, and a black swan event in the housing market could be catastrophic. Competition is also a factor. While Zillow exited the iBuying business, other smaller players remain, and the traditional real estate industry is not standing still. This is why a proper investment in a stock like this requires constant monitoring. You can't just buy it and forget about it, whether you're using an individual brokerage account with Fidelity Brokerage or trading fractional shares on Robinhood. The macroeconomic environment is a constant, looming threat that requires vigilance. An investor looking for investment help should consider that this is not a stock for the faint of heart. It's a high-risk, high-reward play on the future of real estate technology. In conclusion, the 4% drop in Opendoor stock today is a reflection of the market's prevailing expectation that the company is a simple, highly leveraged bet on the housing market, vulnerable to every shift in interest rate policy. But the deeper reality is that Opendoor is a technology and data science company fighting to solve one of the most complex pricing problems in the world. The narrative of fear is easy to understand, but the story of innovation and operational execution is where the real potential lies. The market sees a flipper. The bulls see a disruptor. The expectation is that Opendoor will fall with the housing market, but the potential reality is that its technology could allow it to navigate the turbulence and emerge as a dominant force. The tension between these two outcomes is what will define Opendoor's future and determine whether today's price is a warning sign or a buying opportunity. Disclaimer: this content is for educational and informational purposes only. It is not financial or investment advice. Please do your own research or consult a licensed financial advisor before making any investment decisions. Chime. Don't forget to like, comment, and share. Subscribe for more finance updates and market insights.